Hi guys, welcome back to another video by mykayaplus. So today's topic will revolve around asset allocation, and we will look at it from a company's perspective and how we use the same perspective to also look at a person's individual net worth when it comes to asset allocation as well, right? So you might be familiar with the personal one, or you might be familiar with the corporate one, but at the end of the day, if you really understand the dynamics and the meaning behind it, is actually correlated, and you can also, use the same logic, the same principle to improve your own personal asset allocation, and also use it to better analyze companies whenever you analyze your next company. So of course, yeah, we might be talking about some real life companies. So of course, quick disclaimer that whatever that we say or we share our personal opinions only does not constrain you to buy, sell, hold any equities, right? So it's just for the sake of education purposes. So coming back to the topic of this current video, which is asset allocation. Of course, when we talk about asset allocation from a corporate level, it means that when a company has money or has capital, naturally, this money or this capital needs to be put to good use. And there are many ways or many good ways for this company to put the capital into good use, right? So, Chumbing, what are the most commonly methods where company utilizes capital for whatever locations that they have?
Yeah, so the reason why we wanted to use capital allocation as a starting is because think of it, when you run a company, you are like a CEO, and then you have full control of the company. When you have excessive capitals, what will you do with the capitals? Essentially, it's quite similar to how you manage your own life, but we won't go into that yet. I just want to give a few example. If you are running the company and you have excessive capital, what will you do? So some of the quick example, maybe as a layman investor, you would like to see this. You invest into Maybank, for example, you're expecting a good dividend returns. Let's say every year you get 5%, 6% dividend returns. So this is one way of a company when they have extra capitals, they will reward back in the form of dividends. So it's quite straightforward. They get profits and then they share it back to the shareholders. So this is one way of it. But then, is
Yep.
giving out dividends always good? The answer is yes and no. The yes part is, of course, as a shareholder, you're happy because you get the things immediately back to your pockets. But you may take a step back and think, if this guy got so much money and they afford to pay me, let's say, a 5 to 10% kind of dividend, why don't he use the company to do expansion? So it also can give you a direct correlation relationship that if the company giving out a lot of dividend, it also means that the company hitting some sort of roadblock. He don't know what to do next. He don't know what to basically grow the company. Then he giving you back the cash. So another way to look at it from a capital allocation perspective as a CEO for a very aggressive industry or CEO, maybe they will use the money instead of giving back as a dividend, they expand the company. For example, during COVID time, if you are glove manufacturers, you think the demand is increasing at a rate that you cannot imagine. So what will you do? You maybe as a CEO, you make a call. I double the production line, and I expect this thing will last for 5 years. And my if let's say the factory can be done in 1 year, then I can basically grow my revenue double or triples. So it's a logical move, but it can be an expensive lesson if you overdo it. So from a expansion perspective, you also need to take a step back and think, is it purely for growth or are they overdoing it? So this is another angle. And of course, the third part is some of the company, instead of going through setting up factories, increase production line, they go for the easy way out. They do acquisition. So for example, if Apple's, or maybe Apple's not a good example, for Tesla, take it as a EV manufacturer perspective, you wanted to do acquisition of, let's say, autonomous driving technologies. So instead of you invent yourself, you just basically look for some other company that is able to offer you, let's say, autonomous driving technology. You buy them straight away, add into an ecosystem, and you can give it out as a good offerings. But of course, this is a very strategic move. It can be correct, it can be wrong. But of course, from a growth perspective, you would think this company is trying to do something from an ecosystem perspective. And of course, other than that, there's another common use of the capital allocation, which is they will spend a lot of money into research and development. So this is another good example that, for example, some of the semiconductor company, they need to continue to pour in a lot of monies so that they can keep up with the advancement of technology. So it's also important, and you should also check out the different industry. Some of the industry, naturally, they will need to spend a lot more money into R&Ds to keep up with the space. Some of the other industry, maybe yes, maybe no. And of course, lastly, some of the company will basically take the cash and buy back the share. Maybe Jupan, you can share with us what is the reason why the company wanted to buy back their own share.
I think there are many reasons management of a company can reward shareholders. As you mentioned just now, we've gone through the basic one in the likes of dividend payouts, expansion plans, acquisitions, and of course, not to also forget, companies can also utilize the capital or the profits that they are obtained to do share buybacks as also a form of a capital allocation. So, like some countries in the likes of the US, where dividend payouts for non-US residents may be taxed at a higher tax rate. So you have your withholding tax of 30% if you are not a US resident and you're investing in a US company. So that is not really very efficient to transferring returns back to investors, right? Your retail investors or even the company owners who are actually owning the shares. So one way to actually return back this kind of return is actually to do share buyback. So meaning to say that the company will utilize their own profit and capital to buy back shares from the public market, and the amount of shares floated will be lesser. So it's a simple supply and demand mechanic. So when you have less shares available on the market, and when you take the company's earnings and divide it by the outstanding shares, so naturally the earnings per share will go up, dividends per share will also go up, and that makes the prices of the share much more valuable, right? So people will want to buy up or willing to pay up a higher price because everything is being valuated at a per unit price or per share price basis. So this is one way, special way that companies can also use their capital to unlock shareholder benefits or returns by using or doing share buybacks.
Yeah, but also to add on some point, I remember that there's one time before COVID, if I'm not mistaken, Boeing is doing a share buyback activities, and it also means that you are spending a lot of excessive cash to do this kind of activities. And when shit happens, black swan event happens, you may not have enough cash flow to actually run the company. So this is some of the potential drawback of these particular activities. But of course, there are a lot of other examples. We will go through that. The reason why we start with all this thing about capital allocation is wanted to lead to the next topic, which is our main topic of the day, talking about asset allocation on a personal level. Because we wanted to also share a perspective that running your own life, if you don't have the chance to own a company, whatever thing that you have on a personal level is like running your personal brand or personal companies. So you are like a CEO of your personal life. And of course, along your life, you work very hard, you get salary, you get bonuses. Ultimately, this thing is like an asset to you. And of course, when you receive the salary in cash, there is some way for you to exchange the asset into different classes. And of course, different classes represent different so-called advantage and disadvantage. And when we talk about asset allocation on a personal finance level, it's commonly we will go into these 5 categories. The first one that usually go into a lot of people's, you will see this term is stock is one of the option when we talk about owning an asset. Maybe Jupan, you can share what is the advantage and potentially the disadvantage about owning your asset in stocks.
I think the advantage of owning stocks is very straightforward. If we look at the top 10 richest, top 20 richest people in the world, they all share one common trait, which is they derive their net worth from the value of the shares or stocks of equities of companies that they are holding, right? So we talk about how rich Tesla is, how rich Elon Musk is because of holding on to Tesla stocks. Why is Warren Buffett top 5 richest man in the world? Because of his shareholding in Berkshire Hathaway. So there might be different business models out there in the world, and different business models can produce billionaires and rich people. But just because by holding on to the stocks and equities or shares of these companies, and if the value of the companies go up, your net worth will also go in tandem as well. So that is the very straightforward benefit of doing stock investing. But of course, the flip side is that out of so many companies around the world, there's only going to be 10 companies, 20 companies that are considered valuable and that can continue to grow for a long period of time. And if you buy the company at the right time and without needing to do anything, the next 10 years and next 20 years, you will see your wealth grow at a very good rate. But not all companies are like that. You might buy into a mediocre company or lousy company where you see that after 10 years, maybe the share price don't go up as much or even stays flat, or at worst case scenario, share price go down and you actually lost your hard-earned money by picking the wrong company. So that is one thing to keep note of. It's not easy to find a very fantastic company. And I think the other bad advantage of it is that it's not also everyone's cup of tea to be very patient to buy into a company and hold on to it for 10, 20 years to see the value slowly increase. So you need to know what is your preference, even though that, people can get very, very wealthy by doing stock investing or holding on to shares of companies. So really food for thought on that.
For me, I think stock is very good if you talk about entry level. You don't need to spend like 100,000 to own the stocks. Beside, I think why stock is one of the most popular asset when you talk about investment is it gives you a chance to be a shareholder of a large organization. So think of it, you spend, let's say, 1,000 ringgit, you can own a stock of Maybank. You can own a stock of Tesla, for example. So without you actually need to start a company, you can own part of the company that you think is aligned with whatever you like, and you think this has a growth potential. So there are a lot of good factors about stock, but again, the disadvantage have been covered by Japan as well. There's others asset class as well. Some of the other books or some of the articles they might also tell you bond is another option. But for me, I think bond is a bit harder to obtain. It's not that accessible compared to stock, but it's a very stable asset class, right? And of course, another example of a different asset class is real estate or mutual fund. If you take real estate as an example, it's a tricky one. You basically own a physical asset, but I would say it's not liquid at all. It's very challenging for you to let it go within a short period of time. And then there are a couple of processes you need to do, go through a lot of legal processes to let go of properties, for example. But the good side is this is something that you can feel it. You can basically own it, and you also can basically rent the unit out as a form of passive income. But ultimately, if you're interested in real estate and you don't have a lot of cash, there's another way for you to invest into it, which is something called REIT, right? REIT is another way for you to own a set of properties in a very easy manner. And other than that is like commodities, which I think is a bit hard, and like bond is not that accessible. And then the last one, of course, by all means, cash is king. So you should also keep some form of cash in your pocket. So we always listen to this term that don't put all eggs into one basket. I think if anyone with logical mind, you will agree with that. But what is the magic or what is the correct formula to plan it out when you have the opportunity to plan for your asset or allocate your asset? Do you find any guiding principle for someone that are clueless or don't know how to start?
I think it really depends on a personal level. So it's just like, so from the, I think we previously did something on portfolio allocation in our previous video. I think we can put the link up, right? So to put in a very layman term, portfolio allocation or asset allocation is basically just like having a plate of nasi lemak, right? You're going to have a portion of it coming in the form of your coconut rice. You're going to have your hard-boiled eggs. You're going to have your protein. It can be rendang. It can be fried chicken. It can be chicken rendang. You can also have what? Prawns, right? So, and there's also your ikan bilis and also your peanuts as well. So, but no matter how you play around, the core components are there, and that makes it your nasi lemak, right? So, and different people will have different preferences. Some people want to have brown rice as their carbs. Some people want to have the original one, and of course we mentioned the protein part as well. Some people like chicken, some people like beef, and there's no right or wrong to say that having one or doing without one is actually making a nasi lemak not nasi lemak, right? So, and of course, if you are someone who is much more focused in terms of certain preferences, you can have more rice, you can also have more protein as well. There's no right or wrong. So personally, it really drills down to what is your preference and what is your risk appetite and what is your tolerance, right? So you cannot be opting for having more rice if you're diabetic, right? So conversely, the same theory applies. If you are very risk averse, you cannot tolerate high risk, high reward. So you cannot just chuck everything or majority of your wealth into stocks or into much high risk asset class, even though the high risk asset class might give you better returns. Because investing is not a sprint. Right? It's not you invest today, tomorrow you get a return. We don't know when the return will come. We know that for a long period of time, 10, 20 years down the road, there's surely a return, but how can we predict in the next 5 years, 10 years, you won't be needing to touch your money. So the allocation part comes to play that even though if you are a high risk person, you should not also put in majority of wealth into high risk assets, because there will be a time where you need to utilize some of my assets in the event accidents or unwanted situation crop up. So that's where we come to the sizing part, right? You can have more high risk assets in your portfolio, but make sure there is fundamental enough liquidity for you to weather through any unwanted situation, right? So for me, there isn't a fixed one, but I think you might have a rough ratio for people to at least get started, and then from there on, tweak and change the ratio to their most preferred breakdown.
Yeah, so this is seeing it from a very personal level. Different guys have a different view whether to be more conservative or more aggressive. No right or wrong. It can be depends on your current job status, your family's situations, right? But on a higher level, there's also some of the guiding principles that you can react based on the macro economies. So previously, we have covered a quick video to talk about how interest rate, be it increase of the interest rate or decrease of the interest rate, impact the different asset class. We won't drill down in in details for this video. We put a link up there, but this is some of the key summary that we have of the video itself. Like for example, when the interest rate goes up, typically the bond price will go down. When the interest rate go up, the inflation rate will go down. But what is the logic behind all these things, right? You can check out the video. The reason why we want to show this is because the whole economy is like a cycle. There's always up and down. And during the up time and down time, beside your personal risk appetite, you should also do some sort of rebalancing of your asset to react against be it a good time or bad time, right? So you see when there's some news talking about war, then magically the gold price will go up for whatever reason, right? But if you think this is whatever reason, then maybe you are not knowing enough. So there's a reason why you need to look into the reason behind it and then try to connect the dots. And then this rebalancing got nothing wrong for you to actually do it, let's say on a yearly basis, or let's say every 2 years. But it's also, but for me, this is very important. If you don't react against the macro economics, you may be good at setting up your asset allocation at a point in time, but you shouldn't ignore whatever thing that's moving at a higher level, because if you don't basically fine tune your portfolio, at the long run, you may see the negative effect will grow lah. So here's some of key pointers. Try to get yourself associated, besides on the personal level, try to read some news, know what is going on the macro level. It will help you to make some decision on how to rebalance your asset allocation. And then this comes to my last point, probably Jupan can add on later, is a lot of people have the dream that I spend 80% of my time, if I'm given the opportunity, I want to become a full-time trader, I just invest for life. But what I wanted to share is, it may be possible, but it's always applicable for a very little amount of people. You can see someone that's very successful in doing investment. But if you ask me whether I'm super successful in investment, I would say no. And I would say majority of people can't achieve that. It's a dream to become full-time traders. But the fact is, majority, I mean, the public, you will be still tying yourself to permanent jobs, and then you earn enough, and then when you have excessive cash, disposable income, will strongly allocate you to do some sort of investment into any asset class. Else, keeping cash alone, you just it will just depreciating assets, right? So that's why previously, I think Japan wrote an article. Feel free to check it out. We'll share the link as well. Is whether this is important to have a stable and well-paying job. In my personal opinion, is yes, because I always see this is, unless you can do business very successfully, or you are super good at investing that you can do full-time with it. But the fact is, you will be the 80%. You will be having a full-time job and then trying to achieve a financial independence or freedoms. But the fact is, you still need to rely on the job to pay your day-to-days. And for me, you still need to work hard. Investment is not the only way out, because if today you are earning, let's say 5,000, and you can use 1,000 to invest, versus you work hard and 1 year later you get increment or promoted, and then you get 10,000, and you can basically use 3,000 to 4,000 as your disposable income to do investment. Whether you're a good or bad investor, this disposable income level will determine your success factor, because you already have a very big so-called first parameter to play with. A 10,000 with a 2% is like 200, versus a 2,000 versus a 10% is also 200. So you can see, if you don't really have time and you cannot crack how to be better in investing. Just work hard and get more disposable income, and then you can get better at it. This is my personal opinion. I don't know what do you think, Chupan.
I think, I think the purpose of me writing the article is also to highlight the fact that at the start of every investing journey, you won't be getting good returns. You won't be getting fantastic returns. And if you really understand or grasp the true principle of investing, it is the great returns only come much later down the road. That's why you have Warren Buffett writing about his snowball effect. So the snowball will grow larger and larger as it goes down the hill, right? It starts off at a very small snowball, and it only will become significant size after it rolls a period down the hill. It's not at the start. So, but you can accelerate that by actually starting off with a bigger snowball. And of course, how do you start with a bigger snowball? Is actually you accrue, earn, collect much more capital. And that is where the idea for the article came about, which is, so long as we want to achieve certain freedom from investing, but the very fact that if you really want to expedite and accelerate it, you cannot deny that the fact is to start with a big capital, and for most people to obtain huge capital to kickstart their investing journey is nonetheless from getting a good paying job from their salary.
Yep. I think this is pretty much what we wanted to cover in today's topics about asset allocation.
Yep.
Hope to give you some insights. You should always think of it. You are like a CEO for your own self. You have the choice to make different allocation. Always take a step back
Yep.
and think about it. When you do the certain allocation at the point in time, may not be the most effective, let's say 1 year down the road. So always try to
Yep.
stay connected with the macro changes and react to it. I think that's all we wanted to cover today. I think see you guys in the next video. Feel free to give a like or share the video if you find this thing is useful for you, and leave something in the comment section if you have any question. Happy to discuss over there.
Yep.
See you guys next time.
See you in the next one. Take care, guys.
Bye-bye.
Bye bye.